My name is Manjiri Manerkar, and my presentation is based on the topic Corporate Valuation Adjusted Book Approach. In recent years, management consulting firms have started offering companies advice on how to increase their value. This has been possible because of the fear of hostile takeovers. Companies have increasingly turned to value consultants to tell them how to restructure, increase the value, and avoid being taken over. The consultant suggestions have often provided the basis for the restructuring of these firms. Adjusted book value method of corporate valuation is the measure of company's valuation after liabilities, including off-balance sheet liabilities and assets, adjusted to reflect the true and fair market value. The potential downside of using adjusted book value is that a business could be worth more than its stated assets and liabilities. This method involves estimation of the market value of the assets and liabilities of the firm. It is a pointer to the liquidation value of the firm. It is, however, distinct from the conventional book value method. The conventional book value approach relies on the historical book value of the assets and liabilities. But in this adjusted book value method of corporate valuation, the valuation of the assets and liabilities are taken at their fair market value. Valuation of tangible assets. The adjusted book value method of corporate valuation begins with valuation of all the assets of the firm. Fixed assets constitute substantial portion of the asset side of the balance sheet in the capital intensive companies. Land is valued at its current market price. Buildings are normally valued at replacement cost. However, appropriate allowances to be made for depreciation and deteriorations. Similarly, plant and machinery, capital equipments, furnitures, fixtures, etc. are to be valued at their fixed cost, net of depreciation and allowances. An alternative method of valuing plant and machinery involves estimation of the prevailing market price of the similar, similar used machinery and adding the cost of transportation and erection. The other major blocks on the asset side of the balance sheet is current assets. The principal component of current assets are inventory, debtors, and cash. The inventory is valued depending upon its nature. The raw materials are to be valued at the rate of latest orders. The finished goods at the current realizable sale value after deducting provisions for packaging, transportation, selling cost, etc. The work in progress can be valued either based on the cost, that is, cost of materials plus processing cost incurred, or based on the sales price, that is, sales price of the finished products less cost incurred to convert the work in progress into sales. Debtors are generally valued at their book value. However, allowances should be made for any doubtful debts. Valuation of the cash, including balances with banks, does not need any great expertise. Miscellaneous current assets like income accrued but not due, prepaid expenses, deposits made, etc., are to be taken at their book value. Non operating assets like investment, surplus land, staff quarters, etc., are generally valued at their fair market value. Valuation of intangible assets. The valuation of intangible assets like brands, goodwill, patents, trademark, distribution channel, copyrights, etc., is a controversial area of valuation. Several major companies, goods in particular, believe that brands are its most valuable assets, and, and intangibles have significant financial value. Their absence from the valuation distorts the financial position of the company. Hence, in order to ensure that the valuation of the company is reflective of its true intrinsic worth, it has become necessary for companies to determine the value of their brands. There is a large element of subjectivity in the process of valuation of intangible assets. The two methods of valuing intangible assets are earnings valuation method and cost method. Earning valuation method of valuation is widely accepted in most markets around the world. The value of an intangible, like any other asset, is equal to the present value of the future earnings attributable to it. This is two-stage process involving determining the future earnings attributable to the intangible asset and applying an appropriate multiplier to determine its present value. The main drawback of this approach is that the future projection of the earnings may be optimistic. Further, the process of determining the multiplier is highly subjective. Due care has to be taken for the above factors, failing which the intangible assets may be overvalued. Second method of valuing intangible asset is cost method. This method involves stating the value of the intangible asset at its cost to the company. This is relatively easy when the intangible asset is acquired. The money paid to buyer, the money paid to buy the brand can be directly stated. It is more difficult to value the brand when the intangible asset has been developed in-house by the company. The methodology involves determining the cost incurred in developing the intangible asset. The process of identification of the cost incurred is characterized by the great degree of subjectivity. This may have a significant impact on the final valuation. Valuation of liabilities. Recorded on the right side of the balance sheet, liabilities include loans, accounts payable, mortgage, deferred revenue, bonds, warrants, and accrued expenses. The valuation of liabilities is relatively simple. It must be noted that share capital and reserves and surplus are not included in the valuation. Only liabilities owed to outsiders are to be considered. All long-term debts like loans, bonds, etc., are to be valued at their present value using the standard bond valuation model. This involves computing the present value of the debt, servicing both principal and interest payments by applying an appropriate discount rate. Current liabilities include amount due to creditors, short-term borrowings, provisions for taxes, accrued expenses, or advance payment, etc. Normally, such current liabilities and provisions are taken at their book value. Valuation of the firm. A firm's value, also known as firm value or enterprise value, is an economic concept that reflects the value of the business. It is the value that a business is worthy of at a particular date. Theoretically, it is an amount that one needs to pay to buy or take over a business entity. Like an asset, the value of the firm can be determined on the basis of either book value or market value, but generally it refers to the market value of the company. Valuation of the firm can be calculated by following more than one approach. Value of the firm is basically sum of claims of its creditors and shareholders. Therefore, one of the simplest way to measure the of a firm value of a firm is by adding the market value of its debts, equity and minority interest. Cash and cash equivalents would be then deducted to arrive at the net value. One of the reasons why the concept of enterprise value has gained more importance than market capitalization is because the former is more inclusive. Besides equity, it includes the value of the debt as well as cash reserves, which have an important role to play in a corporation's value. A buyer would have to pay off a firm's debts when taking over the firm, and the same could be netted off from the cash and cash equivalents available with them. Another sound approach towards computing the value of the firm is to determine the present value of its future operating free cash flow. The idea is to draw the comparison between the two similar firms. By similar firms means similar in size, same industry, etc. The firm whose present value of future operating cash flow is better than the other is more likely to attract the valuation of investors. Thank you.